Hello everyone, I am Akash Sharak and today we will learn about hedge funds and what are the different structures of hedge funds. And my main objective will be to explain this concept in a very simplified and easy manner so you can easily understand it. So let's begin with the first thing to understand what are hedge funds. So when we see hedge funds, so hedge funds are private investment funds that pool money from investors. So here what happened, lot of ultra HNI investors or institutional investors, they invest their money to a fund manager, and that fund manager invests your money into different asset class. They aim to make profit using a variety of strategies, including taking higher risk. So this fund managers uses different strategies like long short equity, global macros, event driven strategies, and their main objective is to generate maximum return for their investments. So here we can also see, unlike mutual fund, they have more freedom to invest in different type of assets. Exactly. So in mutual fund, they have lot of restrictions imposed by SEBI. So they have in mutual fund have to make public disclosure and lot of other documents they need to publish. But hedge funds have more flexibility and they do not need to give periodical disclosure also. So now let us see what are the structure of hedge funds. So as I told you, hedge funds are like investment club where people pool their money together to invest in different things like stock, bonds, or even real estate. However, hedge funds can be set up in different way, just like businesses can have different structures like partnership, corporations, etc. So today we will discuss four common hedge fund structures like standalone fund, side by side fund, master feeder fund, and fund of fund. And one question will arise in your mind, like why is this important? So, because the structure determines how the fund operates, how money flows, and even how much tax investors have to pay. So, let us begin with the very first kind of structure of hedge fund, that is stand-alone hedge funds. So, when I talk about stand-alone hedge fund, so this is the simplest form of hedge fund. So, you just imagine you and a group of friends decide to invest in the stock market. You all put your money into one pot, and then a manager, like a financial expert, decide what to buy or sell. This is what a standalone fund is like. For example, a hedge fund might only focus on investing in tech companies like Apple, Microsoft, or Amazon. Everyone who invests in this fund is part of the same pot, and the manager buy and sell those stock with everyone's money. So if we talk about what are the pros of this standalone hedge fund, so it is simple to manage because all money is in one place. The manager does not have to worry about different rules for different people. And when we talk about cons, so here the biggest con is, just imagine if you have investors from different countries or with different tax needs. So this structure isn't very flexible. For example, someone in the US and someone in Europe might face very different tax situation. So now we will talk about the second structure of a hedge fund, that is side by side hedge funds. So what happens in a side by side hedge fund, there are two or more funds that invest in the same things but are separate from each other. So here also I will give you a very interesting example. Imagine you are running two clubs, okay, that both want to invest in tech stock, but one club is made up of people from the US and the other is international investors. Even though both clubs are investing in the same things, you keep their money separate. Here is a simple example. Let's say one fund is for US investors and the other is for non-US investors. Both funds buy the same tech stocks like Google or Facebook, but they are managed separately because different investors have different tax or legal requirements. So when we talk about the pros of side by side hedge fund, the biggest pros is It's flexible. Exactly. You can cater to different investors with different needs like tax rules or investment preferences. And when we talk about the cons of side by side hedge funds, so it's more complex for a hedge fund manager because they are managing two separate pools of money, even though the investments might be the same. Okay, I hope you have understood. And if you have not understood, please comment below. I will try to explain it in a more simpler way. So now we will see the third structure of a hedge fund, that is master feeder hedge fund. So the master feeder hedge fund is a bit like a funnel. Exactly. Different feeder funds collect money from investor, and all that money gets funneled into one big master fund that actually makes the investments. Think it of this way. You could have one feeder fund that collects money from US investors and another feeder fund that collects money from international investors. Both of these feeder funds send their money to the master fund, which then buys and sells stocks, bonds, or other investments. I hope it is clear. And if we see what is the pros of master feeder hedge fund is, it is very efficient for managing a large pool of money, especially when you have investors from different countries. The fund manager only has to manage the master fund, but can attract investors from all over the world through the feeder funds. And if we talk about the cons of master feeder fund, the biggest con is setting this up can be complicated because there are legal and tax rules for each feeder fund and the master fund. So now we are at the another. Now we will see the another structure of a hedge fund, and this is also one of the most common structure of a hedge fund, that is called fund of fund structure. So a fund of fund is like a shopping cart that invests in other shopping carts rather than directly buying groceries. In other words, instead of investing directly in stocks, bonds, or other assets, a fund of fund invests in other hedge funds. This structure helps spread out risk. Instead of putting all your eggs in one basket, you are spreading your money across multiple baskets. Each hedge fund it invests in might have a different strategy, like focusing on stocks, bonds, or real estate. Let me give you a very simple example. If you invest in a fund of fund, your money might get spread across several different hedge funds. One that invests in tech companies, another in real estate, and another in international markets. This way, you are diversifying your investments. So the pros of fund structure is it's great for reducing risk because you are not relying on just one hedge fund's performance. If one hedge fund loses money, another might be making profit. So this is the biggest pros of fund structure. And when we talk about cons, so the downside is that you pay fees for the fund of funds and also the hedge fund that invest in. So there's a double layer of fees. So when we see hedge funds, so hedge funds are private investment funds that pool money from investors. So here what happened, lot of ultra HNI investors or institutional investors, they invest their money to a fund manager, and that fund manager invests your money into different asset class. They aim to make profit using a variety of strategies, including taking higher risk. So this fund managers uses different strategies like long short equity, global macros, event driven strategies, and their main objective is to generate maximum return for their investments. So here we can also see, unlike mutual fund, they have more freedom to invest in different type of assets. Exactly. So in mutual fund, they have lot of restrictions imposed by SEBI. So they have in mutual fund have to make public disclosure and lot of other documents they need to publish. But hedge funds have more flexibility, and they do not need to give periodical disclosure also. So now let us see what are the structure of hedge fund. See the conclusion. So in a conclusion, I would like to summarize. So as I told, standalone hedge funds are simple and straightforward but not very flexible. Side by side hedge funds allow managers to manage different pool of money separately, which is good for catering to investors with different needs. Then we discussed about master feeder hedge funds offer a way to manage large sum of money from different regions efficiently by funneling money into one big fund. Then we discussed fund of funds that provide a way to spread risk by investing in multiple hedge funds but comes with extra cost. The choice of structure depends on the hedge fund's goal and the need of its investors. And there is no one size fits all, right? It's all about finding the right fit for both the managers and the investors. So now we have come to the end of this presentation. So thank you so much for your time and attention today. So dear friends, hedge fund might seem complex, but understanding their structure is key to knowing how they work and how they serve different investors, right? Whether it's a simplicity of a standalone hedge fund, the flexibility of a side-by-side fund, the efficiency of master feeder fund, or risk diversification of a fund of fund, each structure has its own unique purpose. The right structure ensures that both the fund manager and the investors can reach their financial goals effectively and efficiently. So if you have any question or would like to explore this structure further, feel free to reach out. So I will end this presentation with a very famous quote. In the world of finance, knowledge is your greatest asset, and understanding hedge fund assets is a powerful tool to help you make smarter investment choice. Thank you so much for your precious time. Have a wonderful day ahead.